Well, for more now on the economic fallout of this Middle East conflict, we can speak to Jameel Ahmad, Chief Analyst at CTG. Jameel, with tomorrow representing the third week of this war, and the fourth week rather, of this war, and unfortunately no end in sight, how are global markets faring right now?
Actually, we're starting to see some changes in investor behavior now as the test of time has shown that, unfortunately, this does not appear to just be a short-term crisis. It does appear to be something that's going to continue for a little bit longer at least, and that's leading to some investor behavior changes. Specifically on global markets, we've got the S&P 500 that seems to be on track as of today to have its fourth successive losses this week, and the Dow Jones this week fell to its lowest levels of 2026. Elsewhere, gold prices just a couple of days ago lost as much as 5%, and this week they've dropped from $5,000 to $4,600, and that might surprise some investors and market watchers. But that's actually because so far during this unfortunate conflict, we've seen a rush of investor behavior towards cash of the US dollar, the greenback. As a result of the US currency strengthening, we're seeing the likes of gold now losing. And elsewhere, of course, we're still seeing volatility in oil, very sentiment-driven market, but oil prices are generally trying to range somewhere around $100.
And you've mentioned, Jameel, that volatility is now starting to spread to other asset classes. Why exactly is this?
It's a result of investors now looking into the unfortunate fact that this doesn't appear to just be a short-term moment for the world. It might be something that lasts at least beyond the end of this month. That means there's going to be an economic implications, and specifically on the investor outlook for 2026. That comes to when most likely it's going to be inflation risks, and also when it comes to global economic productivity and output. But it's actually those inflation risks and the impact this will have on the central bank narrative, and also for everyday consumers on the street, which unfortunately are going to see their disposable income pinched once again. Just a couple of years after we had that generational inflation move with the Russia and Ukraine conflict. Unfortunately, those bruises are still there, but it does appear that we're going to have another inflation shock. And as a result of this, investors worldwide are starting to price in some different alternatives.
And a number of central banks' interest rate decisions and statements were also announced this week. What have they said about the conflict so far?
Well, overall, it's just proven how the investment outlook and also the central bank outlook just over the past 2 to 3 weeks has completely been flipped on its head compared to what we were expecting for 2026 overall. The US Federal Reserve, that's the US Central Bank, they suggested that at the moment, the implications of what's breaking out in the Middle East is unclear. But where the most interesting developments came was actually yesterday from the Bank of England and the European Central Bank. The European Central Bank kept interest rates unchanged at 2%, but they suggested that they could raise interest rates multiple times over the course of 2026, where they were expected just a couple of weeks ago to leave interest rate policy unchanged at 2% throughout this year. That shows how much it might impact Europe. And when it comes to the Bank of England, prior to what's broken out over the past couple of weeks, we were expecting for this month to see the UK Central Bank point out the time frame when they're likely to cut interest rates over the coming months. Instead of this, we had no monetary policy voting members vote for an interest rate change. Instead, they've suggested they might actually need to raise interest rates should we see those inflation risks start impacting the UK economy. And even the Bank of Japan overnight suggested the same thing.
Jameel Ahmad, thank you very much for your insights.